Oh, welcome in to another daily editorial here on the KE Report. I'm chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, Jordan, there's a lot of volatility in a wide range of markets, which includes the precious metals, but there's been one comment that's been coming onto my site quite regularly for all these junior investors. And a lot of the junior, let's say gold or silver stock investors, mostly the gold stock investors, are saying that, you know what, I've heard from all these gold gurus that when gold finally broke out, that the juniors, then they would actually start to have their day in the sun. They would start to outperform and you'd see some big gains there. The argument being that the breakout in juniors still has not happened. There's a lot of exploration juniors that simply are not moving. What do you have to say to this argument?
Well, there's a couple ways to explain this. Yes, I would have thought that we'd seen a lot more speculation in the sector, in the junior sector specifically, after gold broke above the multi-year resistance around 1375. However, even with that breakout, juniors, if you look at GDXJ, I mean, that still has had a decent move since that point, and even the smaller juniors have had a good move. The problem is they need to move a lot more to counteract all the weakness they had before that. So that's one point. The other point I would say is this move has been driven more so by economic weakness and rate cuts than rising inflation, and that's a reason why silver has lagged gold so badly. And the juniors tend to follow silver, or at least they tend to kind of trend the same way. So an economic weakness type of move, more so bullish for gold relative to everything else in the sector. That benefits, producers, royalty companies first and foremost. So until we see kind of a reflation sentiment, which I think is coming at some point this year, because of all the money that's being pumped in, that then juniors and silver are still probably going to underperform. And there's a couple other things I'll discuss quickly, but number one, quite simply, I think we need to see GDX and GDXJ take out the 2016 highs before we see huge speculation and everything running and even turds flying, because turds do fly in a bull market. So until the miners, the ETFs, the indices break above those 2016 levels, I think we could see a lack of speculation, across the board. The last thing is I think we need to see gold and gold stocks, GDX outperforming the S&P 500. Those things are also important to get speculation up in the sector. And the other thing is, a lot of these juniors, they might have, this is getting more micro, but a lot of them probably have a fatal flaw that's standing out.
Okay, so a couple more points clarifying this argument. GDXJ, well, that's not a true junior ETF because just of its makeup. There's a lot of, first of all, miners and larger than simply what most gold bugs and gold investors consider true juniors. But to your point, there needs to be a better outperformance of gold compared to the S&P, especially gold stocks compared to the U.S. equity markets. But even recently, the outperformance of gold to the S&P, I guess, just hasn't been enough to draw more speculators in. How does that play into a whole bull market argument?
Well, as far as a bull market, if we have had a little bit of a bull market in precious metals, but look, and I've said this before, excluding the 1960s, aside from that, basically every bull market in precious metals have been strongly outperforming the stock market. And you look back over the last 3-4 years, precious metals have not outperformed the stock market. The stock market has outperformed precious metals during that time. And, at some point, and it could be very soon, when we see precious metals outperforming, gold and gold stocks outperforming the stock market, that's going to be very significant because that outperformance that you're looking at on the chart, that signals capital moving away from the stock market and into precious metals. And when you get that, you're more likely to get increased speculation, more likely to see, and which increased speculation, which benefits, probably silver, the gold stocks, and more specifically, junior gold stocks. So, I mean, that's another thing that could help usher in a lot more speculation, but we're not quite there yet.
So Jordan, I'm looking at a gold to S&P chart right here, and you know what? The argument I think can be made that at the very tail end of 2018, we started to see a bit of a shift. I'm looking at a monthly chart, and throughout 2019 and now even in 2020, we are seeing generally higher lows and higher highs being made. Yes, it's not a massive change, and we're not seeing this chart spike way up, but is there a bit of a trend change going on here?
Yes, I think it's fair to say. This is something I've been writing about more and thinking about more in the last couple weeks. And, I think yesterday and also last Thursday, in daily terms, that ratio closed at, pretty close to a 3-year high or a 2.5-year high, something like that. Another thing I like is just looking at the 200 and 400-day moving averages. Those are in proper alignment now, and they're both sloping up. So this chart is really primed for, if we get another leg higher from where we are now, that could really solidify that there has been a trend change here. So this is a chart that we want to keep an eye on, really every day, every week over the next couple weeks and over the next couple months as well, because we could see the start of a shift. And, I don't know if the stock market's going to if that means the stock market will have another leg down and precious metals won't. They'll stabilize and maybe rebound a little bit more if the stock market sells off again, or if it's just we get a recovery and precious metals, are outperforming and rising a lot more. I mean, either way, we need to see these levels really become support, and we need to see these ratios move a lot higher. But like I said, definitely something to keep an eye on, because this is, we could see something very significant over the next couple months.
Yeah, it is a bit of a trend change when, quite frankly, we haven't seen this ratio rising until, well, back in 2011. So that's a long time that gold has been underperforming the stock market. And to your point, hey, there's different scenarios here as to how gold can outperform. Really, I think the best one would be if the U.S. equity markets more or less move choppy in a sideways manner and gold starts to get more of that capital coming in. But to me, that would just be the best case scenario. Circling back to some of the stocks, though, we have not seen optionality plays move that much at all, and that is in a rising gold price environment. I think it does just go to show that there is not that much capital flowing into the sector trying to chase these stocks higher. It's still very selective capital, but as much as optionality plays are not the strongest stocks or companies by any means, they are a great barometer for showing just how much money is in the sector and chasing stocks. What's your outlook? What are your recent thoughts on how the optionality plays have been performing?
Well, I think, part of the reason, well, really the big reason, it gets back to what we were talking about at the beginning, which there hasn't been enough speculation in the sector. We don't have the sector outperforming the S&P 500, at least not yet. We don't have that big breakout from the bottoming patterns in GDX and GDXJ. So I think those things have factored in, as well as you look at the move in gold. Other than the last 12 months or so, it's been kind of a steady grinding type of upside move, and that doesn't engender bullish sentiment and the kind of speculation that we need. It maybe it's changed the outlook for a few companies, but it just hasn't really worked yet. And my outlook is I'm constructive on the sector. I'm bullish. I still think the next 12 or 18 months could be really fantastic. But as far as optionality plays, I just think you have to be a little bit careful with your speculation. And, as far as optionality, I prefer to look at something that, maybe it can get built today, or it works at 13 or 1400 gold. It's something that may be able to be financed. And then it can, if we see a price move to 2000, then it becomes really economic. And so that's where you kind of get that huge kicker. I prefer to look at things like that more so than, well, this is totally uneconomic right now, and maybe at 2,000 or 2,500 gold it might be economic. Those things are just way too they're way too out of the money for me to speculate on. I prefer something that it might have some value now, or might be a little bit economic, but then it suddenly becomes a lot more economic at 1,800 gold or 2,000 gold. So uh, it's interesting, Corey, because gold's had a great move, but optionality hasn't worked yet. So I think that'll change a little bit, when these other things change. But I'm still a little hesitant to go that route.
Yeah, one of the other problems with optionality plays is the fact that they don't have a whole lot of near-term catalysts outside of just an escalating metals price, unless they are drilling and maybe hitting some high grade. But one of the characteristics of optionality plays is they are well-known deposits at lower grades, and that's just a tough case for investors that want a quick return to jump on the back of. Let's also touch on silver, because silver has just been moving choppy sideways. It has not broken out from that 2019 spike high. It really is just trading in this pattern. It's a wide pattern, but it is still just a pattern. What's your takeaway from how silver has been reacting to all this fear and geopolitical news?
Well, as we know, Corey, we talked about the importance of 1850 on the weekly and monthly charts. And at the beginning of, I believe it was last week, it looked like silver could get a monthly close above that level, but with the really the mini crash in the market, it got completely blown out. So there's a lot of technical damage on silver's chart. At some point it'll go above 1850, and we'll see a lot of momentum and speculation. But here and now, at least for the short term, the technicals are damaged. And if we look at the macro situation, again, I mentioned this earlier, rate cuts, fear, economic weakness, that's a recipe that's best for gold, and gold, relative to silver. And, that's best for the royalty companies and the, healthy producers. So, I mean, eventually those things will trickle down and benefit the juniors in silver. But at least initially, that cocktail of things is not the most bullish for silver. But I mean, with all that said, Corey, I think at some point this year, the narrative will change. It'll move more towards reflation with, these coordinated rate hikes. It's coming from everywhere. Maybe we get, some kind of a fiscal package at some point. I do think that at some point in the next 12 months, we'll kind of move towards the reflation story. And if and when that happens, then silver will outperform and lead. It's just that, we're not quite there yet. And where we are here and now for silver and silver stocks, the bad news is it doesn't look like there's going to be an immediate catalyst over the next couple months. But the good news would be, if you're a speculator and someone that's willing to wait a year, 18 months, you might be able to get into some of these things at a really, really good price, so that when things turn and the reflation narrative, becomes mainstream, then, silver could really lead. And by you speculating on weakness, you could make a lot of money on that trade.
Well, just a quick clarification, coordinated rate cuts is what we are going through, and that is what, could lead to some more inflation or a reflation argument. But do you see a potential of almost a quick deflationary event happening before maybe the central banks open up their full toolkit and do whatever is necessary to get some more inflation in the system? This deflationary event could very well bring almost everything down together quickly.
It's hard to say. I'm not really sure. I mean, I think this idea that we're going to have some huge deflationary crash, I just don't see that happening. I mean, I think if we get something like that, it would be temporary. I just don't. If you look at, not to drag on here with the answer, but if you look at household savings and household debt payments, this is nothing like in 2008. The debt is with corporations and governments now, and that's very inflationary. That's not deflationary. So I think I'm not that worried about a deflationary shock or some kind of crash. But who knows? Maybe if this virus gets a lot worse and we can't contain it, then it could be a real concern.
All right, Jordan, appreciate your comments and addressing that one, I guess, argument that a lot of precious metals investors, those invested in the juniors, have right now. You know what? I think it just goes to show the type of investor that has come into the gold market, and unfortunately, the investors that are still in the market that are simply just rotating their money within different stocks. But it's those new investors that need to spur some of this growth broadly for the juniors. Jordan, great chatting with you. We will chat again next week. Have a great rest of your week.